In the world of Forex trading, one of the most powerful yet risky concepts is real leverage. Leverage is the ability to control a larger amount of money in the market with a smaller initial investment, allowing traders to open positions much larger than what their available balance would otherwise allow. However, while this tool can offer great profit opportunities, it can also amplify losses if not used correctly. In this video, we will explore what real leverage is, how to calculate it, and how to use it effectively and safely. Real leverage refers to the ratio between a trader's own capital and the capital they can control through borrowed funds. Unlike nominal leverage, which brokers may offer, real leverage takes into account market conditions and real-time risk management. For example, if you have $1,000 in your account and your broker offers leverage of 1/100, this allows you to control up to $100,000 in the market. This means that with just a small favorable move, you could make substantial profits. However, the opposite is also true. A small, unfavorable move could result in significant losses. Real leverage is primarily used by experienced traders who understand how to manage risk and are willing to face potential losses. It is important to note that while leverage increases the size of trades, it does not change the market's direction. If you take a position using leverage and the market moves against you, losses are multiplied just like profits. That is why risk management is crucial. The first step in using real leverage effectively is to calculate the appropriate position size. While leverage allows you to control more capital, it is essential not to risk more than you are willing to lose. While some strategies allow for high levels of leverage, many traders recommend risking only a small percentage of your account on each trade, typically between 1% and 2%. One of the key methods to manage real leverage effectively is by implementing a stop loss. A stop loss is an order placed to automatically close a position if the market moves against you by a certain amount. This is especially useful when trading with leverage, as it helps protect your funds from significant losses. Additionally, using take-profit levels is also recommended to secure profits before the market changes direction. Along with these tools, capital management is another way to manage real leverage. Setting a maximum percentage of your capital to risk on each trade is a common practice. Many traders recommend not risking more than 1 to 2% of your total capital on any single trade. This ensures that even if one trade results in a loss, it won't drastically affect your account balance, leaving you with enough opportunities to recover. In addition to these methods, it's important to understand that real leverage can vary depending on the broker and market conditions. Some brokers offer higher leverage during periods of low volatility, while they reduce it when the market becomes more unpredictable. Understanding how the leverage your broker offers affects your risk exposure and adjusting your strategies accordingly is essential. In conclusion, real leverage is a powerful tool in Forex trading but requires careful management and a well-defined strategy. When used responsibly, it can significantly increase profit opportunities. However, it is vital to understand the risks involved and ensure that the leverage you use is within the limits you can handle without putting your capital at risk. The key to success with real leverage lies in balancing the potential for profit with effective risk management. If you enjoyed this video, don't forget to subscribe to our channel for more Forex content and trading strategies. Give us a like. If you found this information helpful, share it with someone who might benefit, and leave a comment with any topics or concepts you'd like us to cover in future videos.